Okay. Hi, everybody. My name is Denise Mickelson. I'm the Communication Director for the Colorado Restaurant Association. I'm so glad you could be here. This is going to be a very informative, helpful session talking about all the trends and innovations in our industry at a national level. For housekeeping purposes, the recording of this session and Hudson slides will all be sent out via email early next week to everyone who registered for an education pass. And also Hudson will be taking questions at the end. So save your questions. We'll have 2 mics that we run around the room. We are going to get a behind-the-scenes look at what the future holds for our industry, thanks to Hudson Riehle, who I'm going to let Matt introduce. Matt Smith from Pop Menu is the sponsor for this session. We are so grateful for their support, and I'm going to kick it right off to Matt.
Cool. Thanks. You're welcome. Thank you. As she mentioned, my name is Matt Smith, and I'm really delighted to be here to present this program with you guys, to introduce it. But just wanted to take a second and introduce who Pop Menu is as well. When we look at the state of the restaurant industry, we just really know how the skyrocketing costs, the challenges of labor, the discerning customer and how they spend their money continues to be a challenge for all of us on a daily basis. And so how Pop Menu helps in that is we created a website architecture that helps restaurant owners offset the traditional high costs of IT and marketing by bringing back the experience and owning the relationship with their guest in their own digital real estate by making a very unique interactive platform. And that platform then takes that engagement, organizes it for you, and starts re-impression campaigns, helping you achieve your 4 main goals. You need to attract more people on Google. You need to engage with them in a meaningful way to transact with them often and keep them coming back. So a little bit about us. We're going to kind of move on from there. We also not only have this unique architecture, we do some really cool AI marketing. So a lot of this calendar can lay out for you, helping you offset human capital and do more with less. We have an AI answering product and a lot of other things. We'd love it if you'd come by booth 401 or schedule a deeper education. We just like to help you guys see what all options that you have to continue to be healthy as a business. So enough about me. Let's get back on to the most important part. It's my pleasure to introduce Mr. Hudson Riehle. He directs the National Restaurant Association's Consumer Economic Technology, Market, Human Resources, Tourism, and Operations Research, as well as oversees the extensive Knowledge Center activities. So he's been a heck of a contributor to the success of our industry for a very long time. And there's no one better to explain the opportunities and challenges facing the restaurants in the years ahead. So we're very lucky to have Hudson with us today. Please help me welcome Hudson Riehle.
Thank you. Sure. Yeah, thank you. Well, good afternoon, everyone. On behalf of the association's research group, it's a pleasure to have some time this afternoon to talk with you about the current state of the restaurant industry, but perhaps most importantly, where we see it going in the year ahead. My presentation is currently constructed, has 3 distinct components. First, we'll take a look at the overall economic environment, national and local, and in the past, present, and most importantly, future outlooks. Then we'll go and look at how industry performance has occurred against that economic backdrop and how we expect it to occur over the upcoming year. And then finally, have a wrap up. And when you think about the overall economy, there are a whole different bunch of macroeconomic indicators, but these tend to be the 4 that we follow most closely. Real GDP, the top one, is just basically the dollar value of goods and services in the national economy. And real means that it is inflation adjusted. Then income, we tend to track real disposable. Once again, inflation adjusted, disposable means after tax. Inflation, or the overall CPI. And then perhaps most importantly, from the industry perspective, is to keep your eye on what goes on with employment. And there's a very good reason for that, because when people are employed, they obviously have less time for at-home meal preparation. and they also have additional income to spend at restaurants. So if you look at the far right-hand column there, 2025, the overall takeaway from this is that this year will be a positive growth environment for the industry, but it is going to be a more moderate growth environment than 2024. One of the questions we get most often is obviously, well, when is the next recession coming? So it's important to understand the history of recessions and what recessions are. And so currently, if you look at the bottom line, that green there, technically the expansion started right as the pandemic started, 2 months after the initial negativity. So we are already 5 years out from the start of the pandemic and entering the 6th year. And what we're going to talk about over the upcoming minutes is how the industry has fundamentally changed. I mean, basically, COVID changed the world, and it certainly changed the restaurant industry. And those ripple effects are still playing out, particularly on regional and state basis. But before the pandemic, that expansion, 128 months, that is the longest economic expansion in recent U.S. history. So the pandemic was the tipping point, obviously, that the immediacy of all of those mass layoffs, the shutdown of on-site dining, which I don't think anybody in this room could have possibly contemplated, for months and months and even years on end. So the question is, and you've heard a lot of talk over this past week about recessions. But at this point, there's no indication that there is recessionary data coming online. And as we look at employment going forward, even though it is a more moderate growth environment, overall the income levels and the consumer demand for restaurant services will remain a prioritized spend. So looking at the national economy in terms of job growth, you can see February over there on the right-hand side that just came out last week, 151,000. It's a solid number, but you can see the variability which occurs. And so if you take all these months and average it and look at it 25, 24, 23, employment growth, the growth rate, is decelerating, but it still remains positive. Consumer confidence, for all intents and purposes, is a referendum on how easy it is to get a job. And you can see that confidence, since the onset of the pandemic, has hovered around that 100 mark. And in general, when the index gets below 80, it usually indicates that consumers are expecting a recession. Now, at this point, the overall index, you can see, still remains around 100. But if you split that index into consumers' current situations, as well as their expectations for the economy 6 months out, there is a huge gap. In other words, consumers at the moment are saying that they are okay, positive overall. But looking out 6 months, there is noted pessimism as to the course of the economy moving forward. And it's important to understand, we have this saying that in the end, all restaurant sales are local. And that is so true because the economies can vary dramatically. We tend to focus on the national, being the National Association. But if you look at the 9 different census regions, and then you start thinking about the microeconomic climates within various states, in general, it's important as an operator within your trading area to know what is going on with population growth. And why is that important? Because generally population growth correlates with employment growth. And as we just mentioned, employment growth correlates with income growth, and income growth translates into restaurant sales growth. But you can see there's variability in how different regions feel about the economy. East, South, Central, for example, would be Alabama, Mississippi, Tennessee, Kentucky. West, South, Central would be Texas, Oklahoma. South Atlantic runs from Delaware down to Florida on the East Coast. Obviously, Colorado's in the mountain. In Middle Atlantic, which is the lowest confidence levels, that would be New York, New Jersey, and Pennsylvania. Also, too, in terms of trading areas for operators, it's important to understand what competition is actually today. And competition now is more than the operators competing with you in your trading area. The way consumers spend now, and particularly younger consumers, there's a host of competing expenditure areas for their dollars. So if you look at the top two, those two, half of all spending now by consumers on average is for housing and transportation. Housing inflation is disproportionately higher than overall inflation. Transportation spending, in terms of car purchases, the average car purchase now for a new car is around $50,000. The average car payment is well in the $700 range. Fortunately, gasoline prices, which we track quite closely and do vary substantially by region, have remained fairly modest in terms of lack of growth over the past year. But then you look at the other competitions, healthcare. Embedded in there is, for example, cell phone spending. There's a whole host of different competing areas for that consumer dollar. And the challenge for the operator is not only to get that dollar into the restaurant arena, but it is to capture that dollar. And so when we talk about, which we will, about value and promotions, thinking about aligning with other expenditures. In other words, you can take the grocery store industry, for example, even the insurance industry. In many instances, they have loyalty programs that reward consumers in these other expenditure categories. So, 15 years ago, grocery stores started selling discounted gas. Now, what was that doing? That was aligning the food grocery spend with gasoline spending. So there's some innovation going on in the industry, particularly with these loyalty systems now, to not only reward loyalty within the industry, but to assist the consumer in their expenditures in these other categories. Perhaps one of the most important changes coming out of COVID is what's gone on with employee occupancy in these city center areas. And 5 years out, if you look at the occupancy levels, it is an entirely different situation than it was pre-pandemic. And I have to say, after 5 years of this, I think it's important to think of this as being almost a structural permanence now. And so if you look at the occupancy rates, at best, on average, is 2/3, which tends to occur in Texas. And then you can see it drops down to 43%. You think, that's really bad. But most importantly, you have to think of it by day of week now. And so the highest occupancy level in the city centers now is on Tuesday. The lowest, obviously, is on Friday. In many ways, Thursday night has become the old Friday night. So these levels, for the operator in these city center areas, that operation has to be much more flexible. It has to be much more flexible, not only in terms of supply chain, but in terms of labor staffing. And when we start talking about the labor, we're going to talk about just-in-time labor and the ability now to use technology to staff dependent upon this volatility and what goes on in these city center areas. Also, in tandem with all of this, it's important to understand that America as a country still is getting older. And as a result of that, the demographics of the trading areas continue to change. And so if you look at the Gen Z and millennials, there are now 8 million more of those than the Gen Xers and baby boomers. And so operators that have traditionally focused on older cohorts now have to pay attention to attracting and retaining these younger generation cohorts. Because as we go through the data, you will see that the Gen Zs and the millennials use restaurants entirely differently than the Gen Xers and the baby boomers do. Also, looking out over the next 10 years, it's important to understand that the migration, and Colorado is extremely fortunate in this, The population growth migration for Colorado, you'll notice, is green. And it is a much better position to be in than to be in one of those yellow or red states. All of those red states will have fewer individuals in them in 2035 than they currently do. So as a restaurant operator, being in a state with long-term population growth versus long-term population contraction is an entirely different situation. Also, another catalyst in what's going on with traffic trends in the industry relates to travel and tourism. And when we talk with restaurant operators, we emphasize how important it is for them to know where their business is coming from. And so we look at tourism in three primary buckets. Obviously, leisure travel, business travel, and international visitation. But you can see overall for the industry, 30% of all industry sales are travel and tourism related. And the travel and tourism patterns have changed as a result of the pandemic. So if you think about international visitation, and here in Denver, if you look at the international visitation, and a lot of it comes from South America, some from the West Coast and Asia, but what happens is it is now the actual number of international people coming to travel in this country is not going to equal the level it was pre-pandemic until next year. Business travel doesn't get there to at least 2028 in terms of the spending. And so if you look at the leisure market, in many instances, it has virtually recovered. And this is inflation-adjusted spending, all right? So you can see leisure this year is essentially where it was pre-pandemic. Business travel is still at only 86%. And business travelers are very important, particularly for certain type restaurant operations, because they tend to spend a lot more. International visitation, those are the highest spending individuals. And so once again, in terms of marketing and knowing the travel and tourism mix of your business and the ability to promote and encourage, and we really try to get operators to work with their local destination marketing organizations. Because even for the international visitations, it is possible now through the websites to lock in those visitors to come to your brands and operations before they even depart their home country. And business spending longer, the reason that takes longer is that obviously this video conferencing has impacted that demand for in-person meetings. And so just looking at the number of aircraft boardings through this TSA data, you can see the huge drop-off and then the gradual build-outs and then the different COVID variants which kick in and out. But last summer was a record high summer in terms of the number of boardings. And in terms of the transportation spend, when people drive, you can see that part of the reason the leisure market is doing better is because gasoline price, if you go back, 13 years, January 2012, and take in inflation accounts, gasoline is substantially cheaper now than it was a decade ago. And that there are regional variations, obviously, in gasoline prices for sure. And it can range, $1.50 on either side of the average price. But a favorable impact because restaurant spending still is a cash on hand credit business. So the amount of money that is spent on gas impacts ultimately the availability of restaurant spend. So moving on to the industry, this year, despite a host of challenges, restaurant industry sales do reach a record high, $1.5 trillion. It is a staggering figure. It is over $4 billion a day on average. And to generate that volume across the country, there are over 1 million restaurant locations and 15.9 million workers. The economic impact of the industry is even more substantial. And economic impact, this takes into what are called the indirect components. In other words, the supply chain spending of all of the supplies you bring in, kitchen equipment, and also as well as the people you employ and how they spend that money impact. So it's well over 10% of GDP, the economic impact of the industry. So this just looks at monthly sales at eating and drinking places. That's about 70% of the industry. And you can see that technically moving from, January 22nd on the left over to January 2025, that January was a record high sales volume for the restaurant industry. There's an important caveat, though, is that once you take out the effects of menu price inflation, and menu price inflation has been running substantially above overall inflation because of your increased labor costs and food acquisition costs. It's good to see that it isn't slanting down, in other words, going negative, but it is a environment where in inflation-adjusted terms, the gains are tough to get. And when we're talking about how structurally the industry has changed, the association for years has done traffic tracking studies across the 3 day parts there. And you can see on the far left-hand side, top line's dinner, red line is lunch, and green line is breakfast. So the on-premise, the shutdown, drops to roughly about 7% in some instances. Then there are the gradual build-outs. But the most important takeaway from this slide, as you well know, is entering the 6th year after COVID, on-site traffic still has not recovered. And that is an amazing situation. And as a result of that, has huge implications for how the typical American restaurant can function on a longer-term basis. Conversely, if you look at the off-premises, all 3 meal periods have higher levels of off-premises traffic than they did pre-pandemic. So there has been a fundamental change in how consumers overall use the industry now. And when you start looking at this by the different generations, the younger ones are much more predisposed to sustain using their off-premises traffic. Also, if you're wondering what's going on with C-stores and grocery store food service sales, as well as snacking, once again, all 3 of those occasions in terms of traffic are higher than they were pre-pandemic. I know that's not a very attractive graph, but it does show you in that 5-year period, it has been even though there's some variability day to day, month to month, it is a long-term trend which will be sustained going forward. We also track what's called pent-up or unfulfilled demand for restaurants. The blue bars are pent-up demand for, in essence, table service. The red bars are off-premises. And so you ask consumers, are you eating out as much as you would want at a sit-down restaurant or using takeout and delivery? All right. So you can see the blue bars table service right after COVID hit, 83%. It gradually builds down to 42%. But you'll notice in January, it rose up to 48% again. So technically, there is more pent-up demand for table service now because the convenience is being so much more heavily utilized that it's, in essence, deemed as essential and not an experience and more of a maintenance type activity. And particularly, the variability in this by not only age groups, but also by income groups. Not surprisingly, the highest pent-up demand for on-site dining is those with household income less than $50,000. And you can, as you would expect, higher household income, the demand is lower. So to look at it on a broad basis in terms of how traffic has shifted over this time period, that green line off-premises pre-pandemic, even then almost 2/3 of all restaurant traffic was off-premises. It's currently 73%. During the pandemic, there were periods where it was over 80%. But you can see how the different components of that off-premises market have changed over that 5-year period. And obviously, the delivery, even though it's still only 9%, in essence, doubled its share over that period. So when we survey restaurant operators, as we do every year for our annual report, we wanted to make a point of noting how important it is still to focus on building that on-premises component back, because the economics of that are entirely different than that off-premises. And so when we asked operators what's more important for their success this year, building on or off-premises, you can see for table service, those three blue bars on the right, it's well over 80%. And even for the quick service segments on the right-hand side, there's going to be a greater focus on that. And so the business model has changed in terms of the importance of off-premises. If you take some table service multi-unit operators in the United States today, 30% of their sales is technically off-premises now. But as you know, the economics of that are entirely different than that on-site occasion. The most important thing still residual in all this turmoil is what you saw earlier from our tracking data, is that lunch and dinner, the highest average check per person occasions, are still down proportionately. And so breakfast has become more important, and that makes sense because the employment overall has picked up over the years. But snacking is a big deal now. And when we talk to operators, we emphasize how important it is in your menu development to have some type of snacking availability. And particularly if you're wanting to attract the younger cohorts, the ability for both online and on-site menuing to have snacking availability. And so when you ask consumers, are they replacing traditional 3 meals with snack items during the day? Notice the difference by age groups. The highest is actually millennials at 72%, followed by Gen Zs at 70%, and overall adults is about 2 out of 3. But you can see, once again, the older cohort is less likely to be interested or to engage in that snacking activity. In terms of operator challenges at the moment, we've run this series of questions for decades now. Recruitment tends to be the long-term top challenge for the industry. But you can see what's happened over the past year is the recruitment and retention, even though it's still ranked number 1, the proportions dropped a little and the economy has obviously moved up. And also, too, notice how labor costs has appeared where it wasn't in the top 5 last year. So it's a rapidly developing situation, but longer term, the fundamentals remain as labor costs will go up, food costs will continue to go up, and consequently, the squeeze on profitability continues. In terms of restaurant employment, you can see it's been pretty volatile. The last 2 months, January, February, actually 57,000 jobs were lost. It is somewhat a longer-term question. Is this just a fluke because of the weather and a couple of other elements, or is it a leading indicator of a longer-term economic challenge developing? And so that's why when the March employment number comes out, it'll give another sign, but that won't be till April 4th. But you can see the variability of how industry hires and declines in terms of employment. So total industry employment, this is eating and drinking places, you can see basically 5 years later, total employment in the industry is finally higher than it was pre-pandemic. The important caveat here is obviously it varies dramatically by region. And so if you look at the states, those states in red, and you can see there are 22 states where restaurant industry employment is still not where it was pre-pandemic level. Conversely, states in green and blue, it's Colorado there is in blue. So that employment level is pretty good compared to what's gone on with the country as a whole. And also, too, in terms of employment, vastly different hiring situations dependent upon the segment. So looking at table service on the left-hand side, the blue bar represents the number of jobs lost and since COVID, and the red bar represents the number of jobs gained. Full service, entering its 6th year post-pandemic, is still down 249,000 positions. And that correlates with that lack of on-site recovery. Conversely, if you look at quick service, snack and non-alc beverage bars, even bars and taverns, employment in those levels, areas, segments is higher than it was pre-pandemic. In tandem with the pressure on profitability, labor, because in essence it represents easily a third of a typical restaurant operator's costs. If you look at that 2021 and 2022, where there were 9% increases in average hourly earnings, that's the highest levels that have ever occurred in the industry's history. Yes, it has moderated, but if you think of it like gasoline prices, it never really will go back. All it does is the rate of growth will decrease, but the absolute level isn't going to. So for this year, the first month out, it comes in at 3.9%. But if you look back there at the left-hand side, which was, the Great Recession and the years after that, in many ways, the lower labor costs in combining with the higher food costs, it was in essence a switch off in terms of the proportions of spend. But looking towards the future, particularly this year and even 2026, there's no reason to believe that all of a sudden labor costs are going to plateau. If this looks at the 12-month change over a longer period of time, and you can see the spike there when pandemic hit and then the gradual decline. But if you go back and you look at the history, where we are now is certainly not where it was at the beginning of the second decade. Also, in terms of competition for employees, these are the job openings by different industries. And in terms of, this is who the industry competes with for workers. So you can see professional business services, for example, that is a lot of white collar, eco-friendly jobs, IT jobs. Then healthcare is the second largest industry in terms of openings. And hospitality, which is us in hotels, is the third largest. And just yesterday, the new number came out, and actually the number of openings actually moved up a little. So, but once again, the most important thing, as you know, is at what price point is that opening required to pay. So looking at menu price inflation, which, in general, as an operator, the consumers are pretty sensitive to increasing menu prices. And so you're fairly judicious with how, when, and where you do it. But with labor costs like that, and we're going to look at food costs in just a moment, it's inevitable that you have to raise menu prices. But if you look at the rate of the blue bars are menu price increases annually, the red bars are grocery store price inflation. And you can see up until the pandemic, menu price increases were usually about 2 to 3+% a year. Pandemic hits, grocery store price inflation goes through the roof. But now you look at where it's all settled out. And in essence, with the new numbers that just came out this morning, menu price inflation moved up to that 3.7% this morning compared to that 3.4% on the bar. So what that means is that still the rate of menu price inflation is double what it is grocery store price inflation. And that creates what we call the value gap. In an ideal world, the industry wants to see relatively stable, low menu price inflation and higher grocery store price inflation. So that's why the value situation comes into play so much going forward. And obviously, too, menu price increases vary by area of the country. The highest increases, which include Colorado, approaching 4%. The lowest is in the Midwest, under 3%. Wholesale food price inflation. Notice that line over the past year plus. Wholesale food price inflation is now running at a hefty 7.6% rate. You can see there are a few years where actually there was food deflation. But going forward, particularly when you look at the different commodity groups and what's happened over the past year, this is the core of all restaurant menus. So the egg situation, which I know you're all intimately familiar with, is not going to be resolved till easily 2026. I mean, that's a fact. The beef situation, if you go back and you look at the size of the herds and everything, in essence, the herd size in the United States now is back where it was in the 1950s. And, to grow a cow is entirely longer period, 2 to 3 years versus growing chickens. So the beef situation, double digits over the past year. Coffee, dairy, chicken. I mean, there are a few commodity groups that are down. But it is an area where managing that input cost and the ability to amend the menu and keep it in real time with what the prices are doing in the commodity markets is critical going forward. The drought continues to play a role in this. Back in the summer of 2022 on the left where we are currently, you can see it's a little better, but in a lot of the food production states, it's still a situation where irrigation is required, and that's expensive. So once again, in terms of the supply chain and thinking through the menu in terms of which commodities are being used and how they're being used becomes much more important. So the menu price inflation above average, what that does brings the focus on value. Over 9 out of 10 operators agree that consumers are more value conscious than there used to be. But last fall, the association launched a research initiative to demonstrate, though, that value is not the same to all consumers. And most importantly, from your perspective, what constitutes value varies dramatically by the segment. So if you look at full-service customers, will they be likely to respond to promotions, but not only promotions, but promotions that are in real time? In other words, something that is, in essence, if you think of flash sales on the internet, the ability to have menu pricing responsive in fairly short time periods becomes more important. And so you can see for millennials, once again, it's high. The Gen Zs are a little higher. But the ability, not only is it the idea of value and promotion, it's how those two things are delivered. Loyalty programs, operators I know have different opinions on this, but the fact is when you look at the younger age groups, they are used to being rewarded for their loyalty in real time. And so that expectation carries over to their restaurant experience. So when you ask them in the decision matrix, where does the loyalty and reward program play? Basically, 3 out of 5 say that it's important ordering delivery, higher for millennials and Gen Xers. But the thing is, when you look at the emphasis on full service versus quick service, what's more important when visiting a table service restaurant? It's not actually the pricing. It goes back to this delivering an experience. And so the price of the meal, amazingly, for all adults, when they're visiting the table service, it's 1 out of 3. The other 2/3 are thinking about the experience. And that what constitutes that entire experience, whether it's design, decor, whether it's the breadth and depth or the narrow focus of menus. How easy is parking? I mean, there's a whole different, we went through the whole list of attributes down to cleanliness of restrooms. But the fact is, it indicates, particularly among families who are time pressed, that where the younger groups who are disproportionately relying on quick service, there is a competitive advantage that can be obtained by focusing on what constitutes the total experience at the business. Labor plays a role in this. In other words, if you look at the number of employees required to generate $1 million in sales, it's 11 compared to all these other industries. So the industry is extremely labor intensive. It has been, it always will be. But how that labor is used and the ability to create a hospitality experience versus what's deemed an essential experience can become a very important competitive point of difference and attract dollars. The digital ordering, this is amazing. If you look at now, and it was over 20% during the pandemic, 1 out of 5 restaurant orders now is digital. It is obviously higher in quick service, but in table service, it's now 1 out of 10. And so that obviously is more aligned with the focus on that off-premises market. But there are now digital orders, right, through tablets and through apps that people do on site. Looking at where operators are going to invest this year, the top is equipment technology, front of the house, more productive and efficient. For example, in quick service, that would be kiosk, video menu boards, beacon technology. In table service, it would be tablets, reservation systems, other accounting, financial systems. And then notice the fourth one, cybersecurity. In terms of how technology impacts, because the industry overall is so labor intensive, when any amount of technology is applied to it, the productivity and efficiency will go up disproportionately compared to other industries. So they say that the investments have made their operations more productive and efficient, a little higher in table service. But another aspect of the technology, which is not really always front and center, is the technology of integration with the staff. So where the training is done and how it's done can increase employee satisfaction and also make it easier to recruit or retain employees. And as we sit here, there are restaurant employees that scroll through an app on the smartphone and look at the openings and vacancies for today and tomorrow and make a decision in real time as to where they will spend that day working in a restaurant. So it is a rapidly evolving labor structure built out of necessity because labor costs have become so high and the traffic environment and volatility has changed. In terms of the occasions, just like table service experiences versus a essential dining occasion, delivery is unto itself almost an entirely different business in terms of how it's used and perceived by the consumer. And this is the one area that the consumer, particularly younger ones, expect to see technology. And so 75% of delivery customers say that they like the ordering and payment. And even on-site, when you survey customers, where do they want to see the technology investment? It is in the ordering and payment components of the experience. And so we did a technology study, and to try and simplify it, these were what we viewed as the four technology investment buckets. So there's the marketing and sales component for loyalty, menu pricing, beacon. Then there's the customer experience, what they see and use, the smartphone apps, how they order and pay. Then there's, perhaps most importantly from a cost management standpoint, there's the operational efficiency. And many of these finance payroll systems, in terms of the ability to project and schedule supplies, becomes more important. And then on the right-hand side, it's more futuristic AI. And when we ask operators, are they using AI? Not surprisingly, most of them don't know, unless you're a multi-unit operator. So the ability, though, for this technology to manage the supply chain, project demand, in terms of the ability of personalization of ordering, it's moving very rapidly. So quickly moving over to what's going on in food and beverage. Every year the association surveys dozens of culinarians about what they think the top trends are going to be. We give them a list of dozens of different food and beverage items and potential developments. So this was the top 10 out of it. And there are three themes, essentially. Obviously, sustainability and local sourcing. A lot of that is eco-friendly. We'll talk about local sourcing in a minute. Then is globalization. And Asian food has always been extremely popular, but now it's focusing specifically on Korean and Vietnamese. And then finally, the focus on health and wellness. In other words, the ability to use food and beverage as medicine, particularly among the younger age cohorts. And so, there's this term that I've learned in the past, I guess it was 2 years ago, SWICY, which means sweet and spicy. Particularly among the younger age groups, there's greater emphasis on these South Asian flavors. Wellness, and this is in both food and beverage, but doing this, and particularly dependent upon your demographic base, it's important to communicate this both online as well as on site. That if you are serving beverages now that are perceived to be wellness beverages, that you point it out and describe what's in them. The eco-friendliness for Gen Zers and millennials, particularly Gen Zers, their expectation of restaurant patronage includes being eco-friendly. And going forward, part of eco-friendliness is viewed as eating local. And so when we surveyed consumers about why they like locally sourced food, you can see not only does it vary, what's important vary by the different age groups, but it is an important factor in their decision-making process. And you have almost 2/3 of all adults say the availability of locally sourced food is important to them. It's important, once again, to communicate this to them, either online or in the physical menu on site. In terms of beverages and specifically alcohol and non-alcohol bar options, you can see that new offerings, particularly in the mixed cocktails for both alcohol and non-alcohol, is the highest proportion of operators that are planning to do something. And once again, the ability to create experience and describe this and visually portray it. And also, don't forget, too, that in many areas, the ability now to have alcohol delivered with that off-premises meal comes into play. So if the website is very important visually, that if one's going to enter this arena, that it be visually and verbally written, communicated. Also, too, the idea of using a restaurant or dining at home is no longer an either-or situation. And this is only going to continue to increase over the next decade as well. We call them hybrid meals. And so the ability now to have on the restaurant menu items that can supplement somehow a home-prepared meal. And in terms of marketing and promoting that, because particularly when you look at the growth in snacking, the ability to have offerings that are not in and of itself a whole meal solution from a restaurant. All right. And if you think about Thanksgiving historically as it's developed over the decades, more and more restaurants offer that hybrid meal solution on Thanksgiving now. All right. So to wrap up, we're all fortunate to be allied with an industry the consumer wants to use. This is a Gallup annual survey where consumers voice which industries they view favorably and not so favorably. And so restaurants, even coming out of the pandemic, still over 1 out of 2 have a positive view. Farming is the highest. And just in case you were wondering which were the least positively viewed, I don't think this list will come as any surprise. In terms of operator outlook for the next half year, the blue bars are expecting better conditions. The yellow bars are expecting worse conditions. You can see that election bump of better conditions in 6 months has evaporated somewhat, and there's increased negativity and lower levels of expecting better conditions. The industry this year, almost 16 million, but over the next decade, that number will continue to grow, 17.4 million. The rate of growth is slower. And the industry truly has become an important training and developer of our national workforce. 63% of all adults have now worked in the restaurant industry. Higher for the Gen Zs and millennials. But the industry is an industry now that impacts national economic statistics. And if you go back 30 years, when the workforce proportion wasn't there, the industry has become an important training and developing ground. Looking specifically at Colorado for the upcoming year, you can see employment we expect to be positive, income growth positive, and population growth certainly doing better. These are all above the national averages that we project out through 25. So to wrap up, the industry sales do continue to advance this year, but it is a more moderating environment. The demographic and geographic permutations of this are quite strong. The industry, the technology integration becomes front and center. The essentiality of consumers using restaurant grows, and it is much higher among those younger age cohorts, which are deemed as essential. In terms of the trends this year, focus on value, return to focus on off-premises, loyalty, cost management with higher operating costs, experiences, personalization, and digital. So consumers this year, particularly as the economy moderates and there's this uncertainty, do become tighter with their purse strings. And so the ability to nudge and incent that consumer to step up and maintain their patronage as well as maybe even increase it, technology really can offer a distinct competitive advantage. So that concludes my presentation. Thank you. We have 5 minutes to spare.
He's a pro. If anyone has questions, we have a mic on both sides, and Hudson's here to answer whatever's on your mind. Or did he just explain it all so beautifully that all questions have been answered?
I'm here for a while. Thank you.